Our stocks finished the week off on a little bit of a high note, though closer towards the lows of the day. Though it was up, thank goodness. We didn't have a 4-day losing streak to start off the year. Though after finishing the Santa Claus rally period on a negative note, we are likely now to finish off the first 5 trading days of January seasonal period on a negative note. And we talk about that in today's video and other indications that aren't showing the best signals right now. It's one thing to, get a normal breather, especially after such a parabolic move. The problem is when that normal breather turns into something more. Are there any indications of that? Right. That's what we always look for. You always expect breathers. You always expect the dips to bounce. Stocks bounce more often than they don't. So you expect the dips to bounce unless they still show more signs of being more than normal. So we're going to break down the decline over this past week in context and what's really driving a lot of it, and how likely that primary motivation is to continue to potentially drive declines throughout the rest of this month, and the impact that can have on the rest of the calendar year. So we're going to break all that down in today's video, how the sectors have been responding to the weakness in context of their recent strength, the different relative strength of the sectors, and what the rotation in those sectors might be telling us too. And then our trade ideas, similar to yesterday's trade, we'll take a look at a stock that's on its own dip and may already be bouncing off of a low point. So we'll talk about how to trade it as well. So let's go ahead and get started. Today is Friday, January the 5th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. And if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up that tab, and hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It's a big deal for us. That's why we always ask for it. So our goal is to get to 100 likes on Twitter. We'll see if we can do that here over the weekend. Like I said, we really appreciate those who do like these day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, the decline we had this week, and a little bit of an update, though finishing closer to the lows of the day Friday, but still 0.75% above the moving average. So the market's, the intermediate line's falling. It's still in the bullish territory. Short-term sentiment's pretty oversold, and actually still finished oversold. Momentum line slightly above the 20th percentile. But at least it's looking like it's trying to rebound. Light pink shading because the intermediate line fell below 80. Dark pink shading occurs when it falls below 50. So we're not there yet. The crossover of the intermediate line and the market sentiment, which occurred above 80, which probably isn't as, it's something to be aware of. You can see this is the last time it crossed over here above 80. We don't have a bull tag yet. A bull tag can either be a bullish bounce signal or the beginning of an extended period of decline. So we'll kind of keep our eyes on that next week. We have the Santa Claus rally, the last 5 trading sessions of the year, with the these last 5 of the year, and then the first 2. So we had a down Santa Claus rally so far. We have a down first 5 days of the year. We have 1 more day left in that. So things are looking from a seasonality perspective a little weak. That's not surprising. How we finished the year, it pretty much set us up for a weak beginning. Now, granted, that doesn't necessarily mean we have to, like we saw in 2017 and 18. The parabolic move just kept going into 2018. That hasn't been the case this go around. Pretty much the calendar flipped, and it hasn't. We're done. Like the intermediate, again, we haven't fallen below 50, so we're not on an intermediate decline yet. So technically, this is still the same intermediate rally, even despite the weakness. And we can bounce off of this. In fact, there's a high probability we will bounce off of this because you tend to bounce more than you don't. That's a whole buy the dip mentality. There's a reason why there's a buy the dip mentality, because stocks go up more than they don't. So there's a higher probability of that happening. But we do need to be aware of the instances, at least the signs of when that might not be the case. And short-term sentiment being as bearish as it is there this week is one of those signs that it might not be. That we've dropped below that 2.5% mark. That doesn't necessarily mean, but it just goes to show we're not as strongly bullish as we were anymore, even if we do bounce back up. Let's take a look at the week. Let's look at some of the other indexes, the Russell in particular, how it finished the week. You can see it finished down on the day, off of its highs, still 1% above the moving average. But look how close it is. Now this is a significant cross. When the intermediate line crosses below the market sentiment line, when they're both between 20 and 80, that is a significant cross. You can see the short-term sentiment has been bearish for multiple days, significantly bearish for multiple days, and has still been. So this is an indication that things might be pretty bearish, and you think, okay, well, the reason why we're so bearish is because we were so far above the moving average. Well, there are other instances here where we're pretty far above the moving average. We got clusters, and we turn, that even though you can kind of see over here, even though we got that bull tag after a pretty good move to the downside, it kept going. Same thing over here. You got a pretty decent move. You were way above the 30-day moving average. You had a decent move to get to the bull tag, and then you just kept going. And so now, granted, there was a day or two of rally. There was a day or two of rally there. So there might be a day or two of rally this week. But I think, especially as we're heading, both of these were crossovers of that market sentiment line. It appears that's where we're headed to this week. Again, don't be surprised if we don't get a week or a day or two of some increases first, or even after, right? You can see a little bit after too. But those both started some intermediate declines. We kept because of just how bullish we are, and they eventually swung from these big 10% rallies above the moving average down to near 10% declines, about 8 3/4 to 9 and to over 10% declines below the 30-week moving average. So we'll see how that turns out. There's precedent for that. We'll see if that turns out to be the case this go around. Of course, your NASDAQ has been the big loser here because of the Magnificent Seven giving up some of its gains. Again, it also has had the crossover. Its intermediate lines actually we did get the bull tag yesterday, as I mentioned in the last market outlook video. We have not extended. We haven't bounced. We haven't extended either. Short-term sentiment is pretty strong, and the intermediate line is almost out of bullish territory and almost showing dark pink shading. So we'll kind of keep our eyes really closely on that one. Again, my expectation is, because of what we're seeing on the Russell, that we probably will end up continuing to the downside here. That's my expectation. But if we're going to bounce, we'll know really quickly here next week. Let's take a look at the weekly market forecast. Let's go to SPX first, since it is the end of the week. And you can see big drop in the momentum line. The near-term line already out of bullish territory. So we went from extremes to boom, out of bullish territory, and almost already in the lower half of the chart. So just that quickly there, a change in near-term sentiment. Of course, the intermediate line is still way up above there, so it's going to take a pretty decent drop of the short-term sentiment to the downside. But that's a bigger down week. I mean, we just had a 9-week streak. It's a bigger down week than we've seen in almost a quarter. Looking at the Russell 2000, it's actually worse. It's you can see a bigger decline there. The short-term sentiment got to extreme lows on the momentum line. The near-term line did fall below market sentiment. Out of bullish territory and below the middle of the chart there. So, again, we are seeing a more significant decline in short-term sentiment on these other indexes. Remember, the NASDAQ did finish the year with a cluster on the weekly chart a couple of weeks after smaller weeks. And then now, again, same thing. The near-term line has dropped below 50. The momentum line is not extreme, but it's well into the reversal zone, and with a pretty significantly bearish candle that we just don't see. And you can see that here. All those pretty bearish candles set us up for these transition candles, right? You got that transition candle there, which again looks like a bearish candle. So we're set up for this transition to lead, like this one, to more weakness, more bearish candles like we see on some of these other transition candles that you get. right? And you can look at the Russell 2000. And again, remember the Russell 2000, a few weeks ago I talked about how big that body was and the long upper shadow. That was an exhaustion type pattern. We've had a couple more weeks of rally, but they were really kind of smaller rallies here. And it kind of filled in very similar. I talked about this over here. So instead of just getting 1 week to fill in that upper shadow before we got the transition there, like we did in November, we had 2 weeks probably because of Christmas, a week where we didn't move anything, but we filled in the shadow. We got those big candles, and you can see we broke down hard to a bearish candle already, and a pretty significant transition candle there. You can see here how big that candle. So again, the expectation is, as we saw in November, that would lead to more declines. And you saw some of these other instances, some of these other examples I shared with you, where we were far above the 30-day moving average and we dropped. That's kind of the same pattern. I mean, in August we had these big candles, and then we dropped. And that's kind of what pretty rapidly we went to a bearish candle from a strong bullish candle, but it was slightly below the moving average, to a negative candle fast. And again, same thing, big candle, and then the next candle was pretty decent size, but below the moving average, and then boom, drops to negative in 1 week there. So those are some patterns. Those aren't some good patterns that we have going into the new week here. The full week, right? This will be the first full week we've had in a couple weeks. Remember, next week, after next week, the week after is another 4-day week, holiday week. So something we have to kind of be aware of there. But you can look how strong the bearish sentiment is. I mean, look at that MACD histogram. Again, we haven't been this bearish since, if you follow my cursor, all those other 3 red arrow signals that we've gotten that have bounced, the histogram wasn't nearly as bearish as it is now. If the histogram is bearish as it is now, it typically leads to an extended period of pink shading up on the chart, which means an extended period of 3 red arrows. Now, we don't have 3 red arrows yet, but you can, again, that's the kind of bearish sentiment that leads us to that. You can see, I mean, look at IWM. Let me go back a few years so you can see bullish and bearish trends. But here is how bearish the sentiment is. And again, you can see the 3 red arrows that lead to bounces don't get this deep on the momentum to the downside. And the 3 red arrows that lead to extended periods of pink shading do get this low. So that's a pretty deep low point. Again, not quite 3 red arrows yet. The Qs do have 3 red arrows, right? We do have 3 red arrows here. So we have started the pink shading, and you can see the bearish sentiment again is more bearish than any of these bearish sentiments were. We have more momentum to the downside, the type of momentum that doesn't lead to bounces typically, that leads more to extended declines. And we are already in bearish territory on the stochastics. If you look at the stochastics here on the S&P, we're out of bullish territory, but if you look at the NASDAQ here, we are actually in bearish territory. We're below the 40th percentile. So we are clearly out of bullish and into, now it's only slightly, we can bounce off of this, but still that's a foray that we haven't seen into bearish levels that we haven't seen for quite a while. Looking at the 3-day, the three green arrow, the breaking those lines out. Again, we're below the 17-day moving average. With the MACD dropping, that's negative. Stochastics almost in the bearish territory there. Remember, I said the Qs are. There's the Qs dropping in the bearish territory. The MACD is almost negative, as we are clearly below the 17, and the 8's almost crossing the 17. Now the next stage would be the 8 and 17. After the 8 crosses the 17, which is the blue line crossing 0, the 8 and 17 cross the 30. Those are the kind of the stages of pullback. So we'll watch for that. Again, IWM is so far away from that. The MACD is actually still pretty high above 0. But you can see we are also in bearish territory on the stochastics. So we are below the 17-day. That's your first stage. The next stage is the 8-day to cross below. The stage after that would be both of these to cross below the 30, right? Those are the different stages. So we have the 1 stage on IWM, and looking at the weekly chart, you can see again we're well above the 8-week. But look at that reversal pattern. Look at that MACD histogram rolling over. The Qs also flirting with that 8-week as that histogram rolls over, and the MACD and the stochastics is getting a bearish crossover at high levels. So you can kind of see the weakness. At the very least, we can say that bullish momentum, that parabolic move is done. I mean, we're still above, well above 30 and 25 on the ADX, but it's falling rapidly. We're below 25 now on the positive indicator. We're not quite above 25 yet on the negative. If you look at the Qs, we are above 25 on the negative and well below 25 on the positive. And if you look at IWM, you are almost above 25 on the negative and not quite below 25 on the positive. So you see, it's a pretty dramatic reversal. It doesn't seem to be, because in light of the parabolic move, it's not that big of a move. But you can see the momentum, because of how small the range has been. The momentum it is actually more negative than what we think. There's your SPX, not looking so bad. And the NASDAQ is in the lower half of its chart and well below minus 100 there. And then the Russell is kind of looking like the S&P on the RSI and the CCI. Ichimoku Cloud still shows an intermediate trend, a mature trend strength. We're still above the blue line, so we're still okay. We haven't lost the trend yet. Positive rate of change. Remember, you get below that blue line, especially when there's such a wide gap to the cloud, then that opens us up to a move none of us want. The Qs have lost the trend, so we have hit zero on both of those indicators at the bottom. IWM not quite. It's like the S&P, and look how wide. We do not want to break the blue line, because it leads to filling in that gap to the cloud, and that's a big gap to fill in down to the cloud there. Things can get pretty negative in a hurry, especially on IWM, as I mentioned yesterday's video. How wide the bandwidth is opens us up to big noisy moves, not necessarily trending moves, but noisy moves, because of how wide the bandwidth is as it's shrinking. We are definitely in the lower half of the bandwidth now and losing positive momentum rapidly there. In the Qs, we are almost in the lowest quartile. We're in the lower third, so easily there in the bottom half again. The bands are moving inside the Keltner channel, so we are transitioning from a bullish momentum. Last time we just transitioned to a new leg higher. This time it appears we're transitioning to potentially a negative momentum move to the downside. Looking at today's intraday range, you can see, again, we finished near the lows of the day. It was a slightly lower high, a slightly lower low, but below the midpoint, the point of control the last 4 weeks, flirting with being below the value area. You can see the margin of safety does not look good at all for SPY. The Qs, you can see, are in the lower half of their chart. Again, also below the value area, no margin of safety below it either, because of how fast we move up here. And again, same thing with IWM, below the halfway point of the chart, below the point of control, and look, just because of how fast you move up, no support below this area. So we're going into a new week with a very, very poor margin of safety, and we're also going into new week without, going pretty much this whole week without a new high point. So within a day or two, this green line is going to be below 70. And you can see the low point is going to be moving up now every day. So that's how close we will be by the end of the week. There's a very good chance we get a new 4-week low point, which means, after crossing below 70, we get the spike to 100 on the red line, which coincides with these beginnings of these declines. And with how low even though the Bollinger Bands are pretty high, the 4-week range is really low, in context here. You can see how low it is. When you get these corrections, they get higher. But as of right now, even during some of these pullbacks, before these pullbacks, we're at pretty low levels. And we're just going to get lower as the lows move up and the highs don't move at all. So, we are setting up for a squeeze type play. Now, again, we ended the week with slightly above average, both volume and range. That range is still really small. So we're not bearish, even though there's some signs that we may start to be that way, especially with the increase in volume, right? During this rally and subsequent decline, the volume is picked up, and increasing volume is not bullish, right? It tends to be more bearish than bullish there. So especially considering the increase in volume with a really extremely low range. over here you had a pretty increase in volume during a rally, but the ranges were still pretty high, well above 1%. Not the case now. So the increase in volume has occurred with an extremely low average range relative to the price, well below 1%. Again, squeeze type pattern, squeezing to a more volatile move eventually, and considering the VIX and how low it's been, and this, as we've been talking about for multiple weeks now, the potential for the VIX to have a bounce type move, even with the VVIX dropping hard here at the end of the week, the VIX not dropping as hard, but finishing at 1342, finishing also near the low end of its week, right? So the S&P closed near the lows of its week, and so did the VIX. So here's the S&P. The S&P, you can see, closed near the low of the week, but the VIX also closed near the low of the week. With the VVIX, if I look at the VVIX, which is what you see on the right, the correlation in the purple, the VVIX closed at its low of the week. So, again, it's not like we say, okay, well, we had some weakness, but we closed at the highs of the volatility. And generally, when you notice that, like, you don't get a whole lot of successive green bars here on the VIX when you look at this chart here on a weekly basis. You notice you don't get a lot of, you tend to get like one-off weeks of green bars, maybe one or two smaller in a row. But this week was a green bar where we finished at the lows of the week. So, that's the type of setup that would suggest maybe there might be another green bar. Let me look how much. I mean, we pretty much gap up every week, but we gapped up and pretty much finished it. So that's the problem with this green bar, is it's not high enough to suggest, oh, well, then the next week we'll just drop, or the next week we'll, small gain, or the next week we'll drop, or the next 2 weeks we'll drop, or the next, 6, we'll have a small up week, but then we'll drop for 6 weeks after that big move. Not big enough, and more likely to set up for, you can see this type of move where we've been negative on volatility. You start off with a gap, but still finish near the lows of the week. Here we gapped up over here. It's about 5.7%, but we only went up 7, so it kind of led to the same type of move here. We gapped up 9, but only finished up 7, and then we had the bigger volatility moves of 24 and 18% before. That's the kind of setup we have going into next week. All right, now as you can see, what's driving the price action here, you can see we've talked about this yesterday too, the rotation that we've had into lower yields, lower commodities, lower dollar, all three things, the three-headed monster, right? Well, we're rotating. And if you look at, now let's just look at today first. Let's see, since this is Saturday, we'll go to yesterday first, and you can see, okay, yields were up. Commodities were up. The dollar was off of its lows, right? Started really weak. So while it was weak, dollars really had a bigger influence than anything, because you can see commodities were up early too with the weak dollar. But then the dollar came off their lows, finished with a gain, and equities came well off of their highs as a result. Yields also started down in the morning with the lower dollar, but then yields were finished near their highs of the day. So if you take a look at the yield chart, you can see, again, closing above 4%. We started off the day strong. We dropped on the ISM services down to 3.95 and then finishing back up to 4.04. Again, back above the 17-day, the MACD clearly rising here and flirting with getting back above the 200-day average. The 200-day average right now for the 10-year yield is 4.04%. So we're almost back above that. We've only spent a little bit of time below that average, and now we're almost back above the average. We were in this kind of, you can see, when you're looking at a long-term average value, we've been above the average for a long time. We've only had a brief periods of time where we've been below the average of the 200, when we changed the regime back in the end of 2020. brief periods again below the average, but we've been rising. And here's another brief period below the average. Are we set to rise back up? You know, where here's one, how far we were from the 200-day moving average. You know, we've gotten up, you know, pretty far, like double the average, a couple, you know, there, and about 3/4 of the average there, and then a pretty decent move, about half the average there. This one ended up being about 1/4 of the average there, interestingly enough. And you know, how far will this go up? Will we go back up to a pretty decent amount above that 4.04 average? Remember, the average rises as you get above it, so it won't stay at 4.04%. So that's why they get smaller and smaller, because the average gets bigger and bigger as we go up. But you get the sense, you know, again, look at that stochastics. I mean, we are clearly moving in a different direction on yields, and for that matter, looking at the dollar as well. Again, you can see we're below the 200-day average of the dollar, of where the dollar has been. And we've been below that for most of 2023, and why the markets were as bullish as they were. But you can see now, if I look at the daily chart, big range today, big ups and down moves, but we've started the day above the 17. We finished the day above the 17, and you can see the MACD is above its, well, let's go back to regular MACD here. You can see on a regular MACD, it's above its moving average, and rising, not quite above zero yet, but rising. And so as it gets above zero and spends time, and we are above these averages, will we get back above the 200? Very likely. We'll get back above the 200 if that ends up being the case. Remember, the 50 still is above the 200. And if we make a run here, you'll probably get back above the 50 as well before it falls, or maybe just briefly falls. So really important to watch to see if we falter again like we did last time, which would be bullish for equities if we did. We really want to see that. Otherwise, a move up here and a move up into the bullish territory for an extended period of time is not good for equities. Finally, the last of the three-headed monsters is commodity prices, and which have been so bearish for this past couple of months when the stocks have really taken off. Extremely bearish, right? I mean, commodities, you look at the DMI for that ETF, and it's a pretty decent level, how big they got, multiple clusters. If you look at the weekly version of this, you can kind of see, you know, pretty decent sized move on the negative indicator, about as big as it gets, absent, you know, the economic shutdown there, but also about as low as the positive indicator has gotten, again, since the economic shutdown. So pretty darn extreme for this to be at, you know, as for the range to be as wide as it is between the two. So we're pretty darn low, and you know, any increase, especially any increase in commodities, will have an impact on inflation expectations. One of the nice things is we've had some pretty tame inflation expectations because of the drop in commodity prices. That's generally the case over the course of the end of the year. But now you can see this is the time of year where commodity prices rise. And that will have a negative impact on inflation expectations as commodity prices start to make their way, potentially, of course, back up to the upside. And you can see inflation levels for the inflation nowcast here for the upcoming months are both expected to be positive. I mean, these aren't strong numbers, but they're also not 0.1 or 0, which is what you need to get to a 2%. You need to be below 0.2 to get to a 2% year-over-year figure, multiples of those. And so you can see inflation is still, after a couple of months here, still expected to, on a core basis, to be near 4%. And the core PCE dipping a little bit below 3% there, but nowhere near the 2% level that they are targeting. So that's a factor, all right, for and increasing commodity prices will influence that in the negative direction. Here is how the asset classes here are performed over the course of the week. So let's go out to the week here. And you can see, again, strong dollar, strong commodities, and higher yields. There's your three-headed monster. And as a result, S&P is down 1.5% this week. Qs are down 3% this week. And IWM is down 3.73%. Going all the way back to the end of October where we peaked. Right, we peaked right there on the 27th. So we're going all the way back to that time frame. Again, the commodities than the dollar were down, and yields were way down. Like TLT is way up. So you see the rotation, right? The rotation back, and I mean they were so oversold that there's an obvious rotation back, and that's continuing. And the question is, will that rotation continue? And that's why we looked at those individual charts, because it looks like we haven't even started to have any kind of pullback to the upside in this case on these asset classes that have a very significant influence on risk appetite in general. Let's take a look at the sector moves here during a week where we were down as much as we were, and you can see again the drop in interest rates had a really good benefit for utilities and real estate. They're both really high up. Financials improving with the yield spread that's not as negative, and technology, of course, and discretionary with the risk appetite. Let's go to first today, just the 1 day move here, and you can see financials, utilities, kind of the same stocks that do the same thing. Staples down, real estate down, impacted by yields, right? But if I go out to the full week, then you can see, again, remember, XLQs are down 3%, IWM's down a lot too. So you have XLY, XLK down, XLC outperforming the S&P, but still negative. And then you have safety trades, utilities, and staples that are positive on the week, and healthcare as well. And then energy, which pretty much has been a safety trade over the past couple of years, because it does well when the markets are dropping, and it hasn't been doing as well, lagging when the markets are rising. And you can see the gains it's had this week. Even though it's off of its highs of the week, it's still gaining and well outpacing like XLK and XLY. If you look at the rotation graph here, like we like to look at the rotation graph on the daily basis, you can see XLK, XLY moving down to the left, XLV, XLU, XLP moving up to the right. So we're rotating towards safety as we speak. And where are we at in the longer term rotation? XLE is really moving down to the left pretty sharply over the past, let's see, there's your 13 weeks, right? Look at the drop that utilities has had since in the last quarter, since we've really been rising up. Real estate benefiting from the falling yields over the past 3 months. Technology doing well too. XLV, XLU, XLP have been in the rotations to the downside. So, there's a good chance that this move may just be temporary. That's why we like to look at like a chart like this, where you say, okay, well, do we have a move here in technology where we may be starting to be a little bit bearish? And if you take a look, we have broken the 50-day average of the ratio. We're below the 17-day for the first time in the past few months. The 8s crossed below the 17-day. The ratio here is crossed below its 50-day average, and you can see the negative levels on momentum and relative strength as we rotate away from technology. Here is the weekly version of the same chart. We've had very strong relative strength. Even at 102 is a pretty high level, relatively speaking, if I were to show you some context here. Absent these tremendous moves to the upside, if you look at 102, you can see that's a pretty high level. 103 actually, closer to 103 is where we've gotten to. Momentum is already rolling over. You can see that we are pretty far up above a high moving average there on the 50-week basis, though we haven't quite crossed below like the 17-week, or for that matter even the 8-week, slightly below the 8-week. So now the question is, are we rotating? And we need to see more than just a week of this. Are we rotating into other areas? Like I said, energy tends to do well. Has had a decline of relative strength over the past, pretty much over 2023. Its momentum may be bottoming out. So if you look at the daily version of it, we are starting to move up in relative strength and almost getting above 100. So you see things are changing. I expect there'll be more of it, but we need to see more of it over the next week to confirm whether or not we're going to see an extended period of volatility, which is seasonally the time of year for that to happen anyway. If you take a look at the seasonality of the S&P, remember we tend to get weakness this time of year anyway. There are 3 periods of weakness. The first quarter is one, kind of the middle of the second quarter is another, and then the end of the third quarter, beginning of the fourth quarter is that third period. And so we'll see if we end. Remember, we started, so we had such a parabolic move at the end of last year. We're set up to be more bearish than we typically are in January. January we're only slightly bearish, and typically, we rise right now and then we fall towards the back half of the month, and we'll see if that ends up being the case this go around, considering that we really ended December on about as high of a run as we've gotten historically. Looking at the breadth really quickly, the breadth has been more negative. We've had 3 days and 4 days actually this week, all 4 days in negative levels, but the last 3 kind of decently negative, but no, not below the minus 35 yet. So breadth has been more to the downside. The money flow, you can see, has been the oscillator for the money flow is clearly in bearish territory now, back below the 50 and below 40 for that matter, as our breadth looks a lot more poorer. So you see how things are shifting. Sentiment is shifting. The new highs and new lows index that we look at, the new highs and new lows index that we look at here has broken. It's gone negative slightly. That's not that big of a deal, but it's negative. But what's more of a bigger deal is it's well below its average, right? That's a change. The skew has already changed well below its average, and the average is falling. That tends to coincide with bearishness when you're below a falling average on the skew. And then, of course, the breadth, which has been so extreme, look, now we're flirting with the average there. The average is so high. Once you get below the average and start to bring the average down, that's a sign, that's coincides with negative price action as well when the breadth starts to deteriorate, especially from extreme levels, right? It's one thing for it to deteriorate from kind of high levels, but as extreme as we've been, we haven't broken below the average yet on the 200-day, but the 50-day would be the first one. And then once that does break, you'll see like this ratio really take off. And when this ratio takes off above its average, that also coincides. That means we're breaking a bunch of 50-day averages. That's kind of a sign of weakness there. We're starting to slowly creep up, but if we start breaking a lot of 50-day averages, then you'll see this really move up, and that will be the confirmation of more of an extended period of weakness. Not necessarily a correction, definitely not necessarily a bear market, but at least an extended intermediate decline pullback, the beginning stages of one at least. All right, so for our trade idea of the day, I want to take a look at Boeing. Let's take a look at Boeing here. You can see the nice little bounce off the moving average there. We've got light pink shading here. You can see from the market forecast chart where that's coming from. There we go. So, we've got the light pink shading as the, that's MasterCard, Boeing. There we go. The light pink shading from the intermediate line being below the 80th percentile, but still in bullish territory, slightly below the market sentiment. So that crossover is a little bit of a concern. There again, we did not get the bull tag yet. Short-term sentiment's already on a rebound up to the upside. So this is a kind of a buy the dip opportunity. Again, as I mentioned in the last video, we're hedged for a downside move, so we're okay to try to speculate on a bounce. As you can see, the MACD histogram looks like it has maybe bottomed there with the histogram turning up. Today with today's rally, working our way back up. We're still well above the value area. Big gap. So if this does falter, it's not going to like mess around, right? So we'll be able to get out pretty early with a smaller loss if it doesn't work out here. But if it does, then, again, the MACD histogram as low as it is and bouncing already, we have an opportunity for some upside if it does work out. Taking a look at some of the other oscillators, the DMI is not at bullish levels anymore, but it's not at bearish levels either, kind of similar to the broader market. Same thing with the RSI and the CCI down to what would be low level, especially the RSI, low levels of a bullish range there, and already working its way back up. Looking at the Ichimoku cloud and the trend strength indicators, again, we lost the trend a couple of days ago, though we're still above the blue line. So again, a break below the blue line and we have a different story. But as of right now, we're holding a bounce off of the blue line and we're back towards the middle of the chart without really breaking into the lower quartile with the momentum declining. A very, very strong momentum that is declining. We'll see if it turns into a bearish momentum or not. Again, very easy to tell when it will, and if it doesn't, then we have a good opportunity for a bullish move, a bullish buy the, like I said, a buy the dip type opportunity. We're still above the 10-week moving average. It's still pretty strong long-term strength there, as the PPO is up at pretty decent levels. Obviously a bearish candle, but not very strongly bearish. We've seen plenty of these. Obviously, if it gets stronger next week, then it's a different story. But we can speculate on an upside move by looking. What we decided to do here was look at, if I can close that out, there we go, a mid-30s delta, very similar to the trade we did on the last Market Outlook video. By the 255, you can see I get about a 2-to-1 reward to risk ratio. There it is. Almost a 2-to-1 reward to risk ratio, a little bit less than that. And again, if it doesn't work out, I might lose a couple $100. But for a $900 reward, that's a decent reward to risk ratio there. Probably don't have to take the full maximum loss. If because of being on the low point, it's going to be really easy to tell if it breaks the low point and continues into more of a bearish directional move or not. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all next time.